So the big question is, should you worry about the next market crash? Every decade, there comes a moment when the world says that this is it, 1929, 2000, 2008 and now 2025. Videos are going viral. They're comparing today's market to the Great Depression and the dot-com bubble. The Shiller P ratio is at 39. AI stocks are 50% of the S&P 500 and everyone's talking about a 40% correction. Should you panic? No. You should rebalance and follow a process. Because the smartest investors don't predict, they prepare. So let's look at the data. The cyclically adjusted price to earnings ratio or Shiller P ratio smooths out earnings over 10 years. In 1929, it touched 32 before the Great Depression. In 2000, it again touched 32 before the dot-com crash happened. Today, the Shiller P ratio is at an alarming 39. Yes, that sounds very high. But here's the truth. Valuation alone doesn't cause a crash. Investor behavior does. In 2000, what happened? Investors rushed into dot-coms with no earnings. In 2021, into unprofitable startups. Today, it's AI stocks. But many of these are real profitable companies with cash flow and moat. So, is the market overheated? Maybe it is. Is it identical to 1929 and 2000? Absolutely not. Here's where the real concern lies. Concentration. Today, the Magnificent Seven, Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta and Tesla make up about nearly half of the S&P 500's value. It means your mutual funds, ETFs and even Nifty 50 exposure are indirectly betting heavily on one theme, AI, artificial intelligence. When one segment drives the whole market, volatility will spike. And this is exactly why we have recommended rebalancing. If AI stocks go up 70%, you should trim a little bit of a profit. If they fall 30%, again buy it at a discount. See, that's not panic, that's a process. The second point which the red flag people mention is that the yield curve inversion. Short-term rates are higher than the long-term rates. Historically, it predicts recessions within 12 to 18 months. The US yield curve was inverted from October 22 to December 24. But here's what most people miss. Markets usually bottom out before recession officially begins. For example, in 2008, the yield curve normalized in May, but markets had already fallen and recovered by the next year. In 2019, inversion lasted months, yet by 2021, markets were up by 70%. So predicting recessions is less important than positioning your portfolio to handle them. And that's exactly what tactical rebalancing does. What is the real enemy? Investor emotions. See, fear always sells faster than facts. Every bear market has one thing in common. Investors who exited too early and then re-entered too late. The Dalbar study showed that the average investor's 20-year return is just how much? Less than 5%, while the market has delivered almost 10%. Now, why is this gap? It is because investors jump in and jump out emotionally. That's why at Enrichwise, clients don't rely on emotions, they rely on frameworks. At Enrichwise, what we do is we manage volatility through three core systems. And what are they? Prague, protect and grow. When valuations rise, we do asset allocation. Book out some profits, pay some taxes and move to debt. When markets correct, we shift back, protecting old gains while positioning for the new growth. The second powerful process is old money, new money. Old money means the capital which is already invested, we have to safeguard and protect it, periodically rebalanced. What do you do with the new money? Your SIPs continues to flow in, take advantage of the market volatility, do rupee cost averaging, use the market dips into buying opportunities. And the third important framework is systematic rebalancing planning, SRP. Every 6 months, align your asset allocation based on your life goals, not headlines. It's like tuning your car. Not when it breaks down, you need to tune it before it does. Okay, let's compare some data of the last 20 years. So without rebalancing, you achieved a CAGR of about 11.2% CAGR, a max drawdown of about 38%, and a recovery time of about 30 months. Now, what happened with rebalancing? With rebalancing, you achieved 12.6% return CAGR over 20 years. A drawdown of only 27% and a recovery time of 14 months. So the numbers are very clear. Rebalancing doesn't just reduce volatility, it actually improves your returns because buying low and selling high becomes automatic, not emotional. Markets are uncertain, but uncertainty is not danger. It's opportunity when managed with discipline. You don't need to worry about the next big crash because you already have a strategy to navigate it. Let the world panic, we'll rebalance, stay calm and keep compounding. I'm Kapil from Enrichwise. We don't predict markets, we prepare you to retire rich.